What do we need to know about inflation? This is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community. After having quite the rally in August, the Fed came out and announced some things, and we had a sell-off here at the end of the month to finish down. What about this inflation and why does it matter? The thing about inflation is inflation's always been there. It is, they say, like a financial cancer that just erodes your purchasing power. Most of the time, people don't wake up in the morning and are worried about inflation. They're worried about a lot of other things that are urgent and much more important. It's only been recently here in the last few months where inflation has shown up in the price of gas or in your electric bill, or if you've been trying to buy a car or you went to go get a mortgage on a house, that inflation all of a sudden is actually hitting a consumer. And I want to talk a little bit today about why that's such a big deal, especially when it comes to investing. Because I think a lot of people are going to position themselves incorrectly on how to combat inflation. So first, what I want to show you is I want to show you something that's called a capital market assumption. And before I show it to you, let me explain it to you. A capital market assumption is where different firms, different economists, different experts basically tell us what they think the future is going to hold as far as what rates of return you can expect from different investments. So whether that's investing in a large cap company or a small cap company or different types of bonds, they're projecting into the future at different time frames what they think. So there's long-term, like 20-year capital market assumptions. There are 3 to 5 year capital market assumptions. And again, it's a guide. So at Forum Wealth, to fight inflation or use it to understand inflation, we use something called a capital market assumption. And we don't just use one, we use several. We blend together different time horizons and different firms' research to basically find out how do they harmonize as a guide in making investment decisions. And so our capital market assumption first takes what the Fed is telling us they think inflation is going to be going out in the next 5 and 10 years. And what this capital market assumption shows you is that inflation rate looks to be coming back down into what was normally a historical average between 2 and 3%. Okay, that's great. But as we look at the fixed income side, so you're talking now bonds, what you're going to start seeing is, because inflation comes back down, the summary of everybody's thoughts of the future is showing that the interest rate environment we're going to be in is not going to be that high. And what we see in the equity side of things, in your large cap and mid cap US equities, you're seeing some rates of return and projections there. And then also in the international markets and the commodity markets. And what stands out to me, if you look at this chart as a whole, is that you're going to get more return, or the expectation is there's more opportunity for return in the equity space than there is in the fixed income space. And why is that? It's because even though the Fed is raising interest rates or fighting inflation, they are coming out of a stimulus environment. And when the Fed is trying, the government is trying to stimulate things, they don't seek to give you much return on safe investments, because having safe investments doesn't stimulate things. It just leaves a bunch of money in safe places. Stimulating things is encouraging people to take risk. And when you're encouraging people to take risk, it often then gives returns for those risks people are taking. And let me show you what that looks like when you actually start talking about what is a real return. And a real return is when you take inflation out of the numbers. And what jumps off the page to me is across the board in the fixed income bucket, the return expectation going forward for the next several years is almost zero. And that's because though the Fed is raising interest rates, they're fighting inflation, but the net return effect of that is they're still encouraging risk. Therefore, those of you that are trying to get out of the markets or are worried about the markets and to go into bonds or go into safe assets, your real return might be a lot less than you're expecting. And the opportunity has been in the past and looks like it is projected to go into the future. The opportunity is in the equity markets. And so we'd encourage you not to panic out of the volatility of the equity markets, because a lot of people are projecting that for the foreseeable future, as has been in the past, that's where the opportunity lies. And we believe that's the best place to beat inflation. The purpose of these up or down videos is to try and bring a little understanding about what you should be doing with your long-term investments based on what is going on. And so this is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community.